In this video, traders, we're going to look at what is a WAT order and how does it influence the market. Stay tuned. Hey traders, warm welcome to So what is a WAT or WAT order, and how, most importantly, how does it influence the market for us retail traders who perhaps don't have access to this order type? Well, let's talk about through what a WAT order is. So WAT order is really called, well, it stands for with a tick. In other words, what this allows you to do is allows you to join the best bid or the best offer. Let's use the best bid in this example. So we're looking about on the exchange, and you would join the best bid, and when the opposite side of the spread, i.e. the ask, drops below a certain contract volume, then you will hit that ask, or you will hop your order up by one. So we don't have access to this. Most of us as retail traders don't have access to this. What we can do, we can actually go with a broker who does allow platforms that support this kind of order. But this is mainly going to be used for institutional order flow, prop firms, more serious traders, hedge funds, that kind of stuff. So for us, if we're spread betting, CFD trading, we don't have access to this type of order. But the important thing is if we know what it is and understand it, then when we start seeing certain types of action in price, we can think, oh, well, actually that might be because of this order type, that order type, and we can kind of think a little bit about who's on the other side of the trade. So let's look at an example. Let's imagine now we have 50 to 51, and here we've got 500 contracts sitting on the bid there at 50, and here we have 300 contracts sitting on the ask there. So just put B and A on that order book. Now we come in and we've already got an order in actually for, let's say, 200 contracts sitting there at 50, but this is a WAT order, and the WAT order is specifying a few things. We're on the bid or the ask, in this case we're on the bid. The threshold, which is either in a percentage or volume. So the threshold is basically at what point does the other side of the spread, in this case the ask, have to get to before we turn this limit order into a limit order plus one or a market order. So in other words, we could say, okay, the volume here, let's make it 100. And that means if we're sitting there and we get filled, then we get filled, great. But if we're sitting there and people are buying the 51s, let's say they buy 100, so it goes down to 200. Let's say they buy another 50 off them, it goes down to 150. All right, now let's say they buy another 100, say, and that would take us down to 50. That takes us under the threshold of 100. It could have been 50, it would have been 100 there. It takes under the threshold. At this point, the order goes from our 200 buy order. We take it from there, and then we hit the 51. So now all of a sudden we get 50 contracts filled and we sit on the bid for 150. Now, of course, if we had a volume of 1,000, that was much bigger, and we had a small contract, that might be better. So basically the idea is, the thinking behind this is, I'm not being filled, I'm sitting on the bid, I'm not being filled, people are taking that offer, people are taking the offer's going lower and lower and lower, there's not much there anymore, all of a second that will go best bid. So before it goes best bid, the idea is that you take what's available left. So you can imagine for a thicker market, like the SP 500, the Euro stock, something like that, if you're sitting on that order book and you're not getting filled, maybe you're at the back of the queue, you're waiting, but then you start to see people nibbling away at the offer until there's only a few left, then automatically the order will go and take that liquidity, or try to take that liquidity, so that someone else doesn't do it, and then that goes best bid and leaves you then not only way behind, but you're also worse price as well, so people can still jump in front of you. So it's a way of managing that limit order and turning it from a passive order into an aggressive order. So what does that mean for us as spread bettors, as retail traders, as CFD traders, all this kind of stuff? Well, it means that if we're trading something like that, and we often see, if we're watching the order book or we're trading on a short-term scalping basis, then very often we might well see instances where price, especially if you're watching the order book, price, the volume's decreasing, then suddenly, before it even gets to a certain point, all of a sudden it goes best bid, and it kind of flicks around like that. So this might give us, if we know that people are using this type of order type, it might be like, okay, well, if we're constantly seeing the price moving up quite aggressively on tick, and obviously we'd have to look at level 2 for this, we see the price, the volume decreasing, then we see someone going best bid, then we see the volume decreasing, someone best bid, we're assuming that potentially if someone is prepared to turn a passive order into aggressive order, that may mean that there is supply demand imbalance if we could extrapolate that into the majority of traders. Not always, of course, but we can start to think, well, if someone's not prepared to sit on that bid and wait for it to come back, maybe there's a little bit more urgency in the market. Maybe if we're starting to see this kind of stuff, that there's a little bit more chance of the market going higher. I mean, if the market was going lower and you believe that you were scaling into a market that's pushing lower, you wouldn't use this. You just leave your limit there and assume that at some point the market would trade through you and trade through your next level, trade through your next level. The only time you want to use this is if you were trying to save that tick, but at the same time still wanted to get in, still wanted to make sure you didn't miss out, preferably at 50, but it has to be 51, then so be it. So anyway guys, that is a WAT order, and that's how it tends to influence the market. Take care and see you next one guys, bye bye.